and welcome to Module 4 of Advanced Economics. In Module 4, we think about money. Now, at some point in almost every teenager's life, they realize that these things that people care about so much are just pieces of paper. Why do we care about money anyway? Well, in this unit, we're going to think about financial systems. The key advantage of fiat money, like this $10 bill, is it serves three purposes that are really important to help an economy function. Imagine you're a goat farmer, and you're looking to acquire other goods. There's some coffee farmer down the road, and you'd like to get coffee from them. Now, if the only thing you have to exchange with that coffee farmer is goats, you really are counting on that farmer wanting your goats over and over again. And so money needs to be a good unit of exchange. You need to find something to help an economy run that is accepted universally by the coffee farmer and the apple farmer and everyone else who's providing goods and services, so you don't have to worry about all of the specific exchange rate and you don't have to spend tons of time haggling. If the coffee farmer doesn't like goats or want goats, otherwise you'd just be out of luck. The second important function that money serves is it is a store of value. And by that I mean it's something that if you're saving up assets over time, and you're saving up just a goat herd, your goats are going to die. And a lot of other kind of commodities, can't really trust in the same way that they're going to hold their value over time, whether it's because people don't want them anymore, whether people find a lot of them. You really need to make sure that it's something that you can expect will hold its value over the long term. Now, these kind of pieces of paper aren't always great at that. We've already talked about inflation, but they tend to be a lot more stable than something like a goat herd. And we'll talk about other financial assets which potentially will hold their value better over the long term, like stocks and bonds later in the unit. The other thing that we really need from a currency is we need it to be a unit of account. And by a unit of account, I mean something that we can use to measure the relative value of all of the different goods and services that are important in an economy. If you can't really use goats to measure the relative value of all the other goods and services, partially because you can't really split them up. But when you have a $10 bill like this that is so easily divisible into other denominations, that's one of the reasons why currencies have big advantages over commodities as a unit of exchange, as a unit of account, and then as a store of value. Now, after we talk about the financial system and particularly the money supply in the United States, we're going to talk about other financial assets like stocks and bonds, which tend to be riskier, but also tend to have larger rewards long term. And we'll think about how these financial markets, the three financial assets of money, stocks, and bonds, are regulated and overseen by the federal government. Particularly, we're going to be looking in this unit at the action of central banks. And central banks use the tools of monetary policy and the money supply to keep an eye on how much currency is in circulation in a country, and we'll see all the other things that central banks can do. Now, the advantages of monetary policy is that you can achieve a lot of the same ends we were trying to achieve with fiscal policy, things like smoothing out the business cycles, without some of the drawbacks. Central banks don't face the same political pressures that the legislative bodies of the United States tend to. And you're going to see a much more even use of contractionary and expansionary monetary policy than you will fiscal policy. So at the end of the unit, we'll examine both monetary policy and fiscal policy together. And we'll think about how governments can use a combination of these two types of policy to both prevent and alleviate the long-term effects of potential financial crises. Until then,